Sorry, my last video got deleted somehow. I think I hit the wrong button. But today I want to talk to you about mortgage, the tax reform bill. You got to pay attention to what was proposed versus what actually was passed, and a lot of people are getting this confused, and it's causing a lot of misunderstanding. So what you need to do is read the tax bill for yourself, but I'm going to go over some highlights as it relates to home ownership and home ownership only. The mortgage interest can still be deducted as long as your primary residence and your second home do not exceed $750,000. The limit originally was at $1 million, but the proposed bill said that it was going to go to $500,000, but they met in the middle at $750,000. So that means if you have a primary residence that's $400,000, your second home is $350,000, you still meet that threshold to write off the mortgage interest, which is not going to affect the majority of people in our area. So you don't have to worry about that. Also, on your primary residence, it capped at $10,000 on the property tax. Most people in our area, their property tax does not exceed $10,000. So again, you don't have to worry about that. The they proposed that they were going to put the capital gains tax at $250,000 for an individual, married couple $500,000. They had said that you would have to live in the house 5 out of the last 8 years, but that did not go through. So it remains the same, that you do not have to pay capital gains tax if you lived in your house 2 out of the last 5 years, because they knew that there was already a shortage of homes in the market across America, and if people had to live there for 5 years instead of 2, less people would be willing to sell their property. So that has remained the same, that you only have to live in your property 2 out of the last 5 years, so that you do not have to pay capital gains tax as long as you are not profiting more than $250,000 as a single person and $500,000 as a married couple. Moving expenses did get repealed till 2025, except for military personnel only. They can write off their moving expenses. Now, can your accountant or your tax person do something different? Yes, but I'm just quoting what is actually happened with the tax bill, nothing else. Also, if there's a casualty loss, it has to be a presidentially declared loss, disaster, in order for you to write it off on your taxes. If it is not, then you just can't have casualty loss and just write off what you want to. Again, you can talk to your tax preparer, because I am not a tax person. I am just quoting what the major things were from the tax bill that is being construed or not understood as far as what was proposed and what actually got passed. Remember your whole purpose of home ownership. Your purpose of home ownership was to achieve the American dream, to make people feel successful, makes people have more confidence. Studies show that people that own their own home, their children tend to do better because they have a stable environment. They're not moving around. Also, you have where you get discounts on your insurance for multiple policies. There's some insurance companies that will give you home ownership discounts because they know that you're in a more stable environment and you're not going to move as much as someone who may be renting. So again, read the tax bill for yourself. It's kind of like the Bible. You need to read it for yourself, understand it for yourself, and don't just go off of what was proposed. Look at what was actually passed, and most of this stuff is not going to affect the majority of homeowners in our area. Again, I encourage you to read the tax reform bill. I'll go over some more things on the tax bill as it affects different people, just because I've been getting various questions about that. I'm just quoting what is actually said in the bill and not my opinion. Thank you.